All right. Hey, welcome everybody, and welcome to our Monday together, going through it together. It's going to be a great week somehow for someone, someplace, hopefully. I wonder sometimes in my free time about a whole bunch of things. I like to consider the how and the why things work before I accept that things just simply work. And I try to wonder about helpful things, of course, most of the time. It's never good wondering about those bad things too much. And that's pretty easy to do. But why are all these hate speech laws being passed? And probably my favorite that I've seen recently, why is King Charles being called on to aid in the fight for alien disclosure? Wow, Fox News or Netflix? Which one's real? Which one's not? But my main wondering point at the moment is, where are mortgage rates going? Now, I know rates drive house prices, interest rates basically drive where house prices are going to go. And personally, in my business, I make more money when people fall in love with the property market. So I want interest rates to go down. So yeah, there's a commercial tilt to my interest here as well. Yes. But this is also an incredibly fascinating journey when I just feel like digging a little bit deeper around how things work. There's always the simpler, though, the more mainstream answers that you can find with what most economists will say and what most journalists will write about in mainstream media too. It's definitely what you're probably going to learn about in your textbooks. Now, I did an economics degree once myself. It took me ages to finish it, partly because I was a slow learner. But here's what I was taught about interest rates. When economic activity slows down, a country's central bank may reduce interest rates to stimulate borrowing. Lower borrowing costs might encourage companies to borrow more because it's cheaper, right? And they might invest in more efficient production methods, borrow more, buy more sophisticated plant and equipment, or they might hire additional staff and set off a bit of a wage inflation thing. As workers gain skills, of course, the earnings will often increase, which then helps alleviate economic stagnation as everyone goes out and they feel wealthy, so they spend a bit more. But as the economy strengthens, inflation might occur. This monetary phenomenon known as inflation is typically characterized by rising prices and increased production costs. Everything just gets so expensive and things just kind of slow down at some point. Out there, you might have heard that the only cure to higher prices is higher prices. But this is what the Reserve Bank of New Zealand here has done over the past 12 to 18 months. They've increased the cost of what many of us have as our biggest expense extremely fast over a very short period of time. And so higher borrowing costs like this, well, at a commercial level, it could cause firms to invest less, and it could force them also to reduce their workforce, as I record this in August 2023. So two useful truths can come out of this sort of mainstream thought that I just rattled off there. The central banks indirectly influence our mortgage rates by what they do in the short term with their official cash rate or their official interest rate or Fed funds rate. So what they do affects the short term, and collectively what they say they will do will affect the longer term interest rates. Secondly, we can also gauge how the economy is going to perform by checking in to see how many people are working at the moment. If the unemployment rate seems to increase, though, if it gets too high, it can signal that maybe there's a need for the central bank to make interest rates lower and therefore maintain consistent economic growth to restore confidence in the financial system. Of course, ironically, they create more instability in the process. Now, there's more to it than all of that, of course, but you kind of get the idea. It's far more interesting going beyond that mainstream perspective, though, I think. Some of the areas that I'm keen to learn more about currently, though, are trends in capital flows between countries and how that's changing at the moment. I think it's interesting how central banks are falling more in line with initiatives that are clearly started right up at the Bank of International Settlements, the BIS. I think central bank issued digital currencies are really, really interesting. How the Eurodollar system works and how it risks making the U.S. Federal Reserve look impotent right now. And there's this one as well. Well, what happens when the countries who traditionally supplied cheap credit to the U.S. start to explore other solutions of where to put their money? It's not just another brick in the wall at this rate, but things like this are all happening all at the same time. So, how does this influence my mortgage rate? Well, in a new world with more centralized government, it's time, I think, to start microdosing on macroeconomics, of course. So if you are proud of your precious paradigms and you follow the experts you respect, I get it. I hate being wrong too. It's a pain having to relearn your stuff after you thought you figured it out. But it makes sense. There's so much change going on that, of course, we have to look in different places and we have to think about these other voices that sound a bit crazy, but it actually makes a bit of sense. Take the blue pill, take the red pill, doesn't really matter to me. Keep your head down though, work hard, support the latest thing, and I'm sure you'll be super happy. But Hugh Hendry, who is he? Hugh Hendry is a former hedge fund manager. He can skate and he lives on a tropical island. Hugh's a well-respected voice and a personality in the YouTube and FinX space, and I'll underline that word personality here. In the first part of this episode, I start off commenting on the fluff on Hugh's microphone, but after that, I think you'll really enjoy the conversation. Before we start, though, over on YouTube, you can catch the full episode out now. Otherwise, I'll share the rest of this episode here next week. Have an awesome weekend, everybody. Let's get started. You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor Podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. Are you holding a little dog there? Is that a microphone?
That is the microphone. No. Okay. Are you just happy to see me?
Indeed. Cool. Okay. Hugh Hendry, the Acid Capitalist, thank you for joining me today.
Absolute pleasure. Let's rock and roll.
Okay. Now, I have been bumping up against you every now and then on YouTube. I've been catching little whiffs of Hugh Hendry, and some of your insights have kind of challenged my understanding, which is still growing, around how the global markets work, how financial institutions work overseas and all that sort of stuff. So I want to start off with the Federal Reserve. And I think many people have views around the Federal Reserve that it is kind of like the puppet master, and that when it prints, markets go up. But are they really the puppet master, or are they just muppety bureaucrats? What's your view on the Fed?
Muppety bureaucrats, I like that. And then your introduction, we were bumping up against each other. I thought we were going into grinder mode. But
I know. Well, it's your microphone, Hugh. It's really putting me off.
I can't win. So to answer your point, it's remarkable the high esteem that the Fed is held in by the very high upper echelons of U.S. money management. I had the pleasure over the weekend. I was catching up on some YouTube interviews with the joint CIOs at Bridgewater, and they have deference for the Fed. They really believe this is controlled by them. Maybe they're right. I don't have a license on the answers, but I think the biggest challenge on that belief is, give us a good example of when of a noble adventure by the Federal Reserve, and an intervention set to, you know, to recalibrate the rate of growth, in the fear that if it wasn't recalibrated, we'd have an inflation problem. My memory goes back at least 25, if not 35 years, and it's really hard. There was the, the Greenspan Fed, I think it was 1992, prematurely, or just at the right point, raised rates modestly, and the stock market went sideways. There were a couple of financial accidents, Orange County. There were a few defaults, but by and large, the Fed had taken the steam out of perhaps an overheating economy, and the next year the financial risk assets were off to the races. That's the
Yeah.
last time I kind of would argue they were the right side of history.
Yeah.
Some might. I'm willing to contend that the intervention at the end of March 2009 um, was a break from a hard money rhetoric,
Mm.
that we're at a point where people forget it now, but Citigroup Travelers was the JP Morgan of its age. If we go back 15 years ago, largest financial behemoth, most respected. It was bankrupt. It was trading in cents on the dollar, and the Fed had a choice. The system had gone digital. It was either going to zero, it was breaking, or they had the chance to reset it and let it come back, and they chose the latter. Um, but they used the camouflage of language, I believe. They used this quantitative easing, and perhaps later we'll discuss that I have misgivings in terms of what that actually is. It just a groovy slogan? Does it actually infer money printing? Question mark.
Mm. Okay. Well, that is kind of like ultimately where I'm keen to go with that question. Actually, is does QE does that equal money printing? Does that equal asset price inflation, and therefore does that equal consumer price inflation? Like, is it again? Is it like a variation of that first question? Is it the Fed that is actually causing inflation, and can they actually control the dog, or is the tail just going to be wagged by the dog?
Yeah, and obviously it's complex, but let's have a go.
Yeah.
I think there are three components to it.
Yeah.
Um, so the first component, the classic, the orthodox definition of money printing, is a bank extending credit. You go, they grant you a mortgage,
Yeah.
and they pass, I don't know, $3 million into your account. And it's digital money. It's a digital ledger, that those dollars didn't exist before. They're in your account, and then you pass them on to the seller of the property.
Yeah.
Quantitative easing um, is, I believe, seeking to um, encourage, foster, influence, make that decision
Mm.
happen more often, so that it makes a difference. It does so in that, if we simplify it, there are three economic agents. There's the Fed, um, there's me. I own a treasury, and there's my private bank. I sell the treasury security to the Federal Reserve, and immediately the deposits at my bank are increased by the net sale proceeds. For the private sector bank, um, again, it runs. This is banking. This is finance. It's all about ledgers, T accounts. Um, the liability, which is to say, my deposits have increased.
Yeah.
So what happens is they get a corresponding increase in their assets,
Yeah.
which would be reserves with the central bank. Okay, so now the private bank, and banks essentially have three assets that they're like a very simple hedge fund, um, and the three assets are loans to you and I and to corporations. Um, they can choose to own treasuries, which are effectively loans to the U.S. government.
Yeah.
And then this third thing, which has really come to prominence in the last 15 years, um, more so than the past, which is those reserves with the central bank. So in this instance, the reserves with the central bank have increased, and
Yeah.
I believe the hope, the desire of quantitative easing, is that the banks kind of look at this asset and they go, yeah, really, And back 15 years ago, the return on a reserve deposit account with the central bank was kind of like nothing.
Yeah.
And so the hope is you're diluting their balance sheet, you're diluting the return on their assets. And so you're hoping that they're either going to buy more treasuries, or even better, the home run is if they extend new credit. So I think
Yeah.
of quantitative easing as being latent money printing.
Yeah.
You're providing you're effectively providing the alcohol, and saying get drunk on me.
That's
Um,
right.
the great problem, and I wrote a paper on this, um, the I can't even remember what it's called, the awakening of chaos, the dawn of chaos, and I was trying to add to the vernacular of inflation and Milton Friedman's great contribution. He maintained that inflation is everywhere and always a monetary phenomenon, which is to say it's that bank extending the new loan. Uh, I believe it's also a psychological phenomenon, and the
Mm.
psychological phenomenon was that the Citigroups et al. Were um, drunk and hungover
Yeah.
post the travails of the crash of '08. And so the Fed comes in with all this alcohol, and they're like, yeah, brother, like,
Hair of the dog. Yeah.
even hair of the dog, but come on, and so, um, have loans grown? Yes. Has it been um, way beyond, if you will, nominal GDP, which might be a frontier to assess and determine just how quickly money is being printed? Not really. And indeed, if you were an alien, if you came in and you didn't know anything about what had passed in the last 20 odd years,
Yeah.
you'd find that M2, the wide common definition of bank deposits in the US, I think it's compounded at a rate of 6% per annum since the year 2000.
Right.
Kind of boring, and yet we've had massive, asset bubbles. We've got asset prices or asset ratios to GDP, which are unprecedented.
Yeah.
And so I kind of feel like the answer rests elsewhere.
Okay. Well, I wanted to get into that elsewhere, but just to make sure I'm really fully getting this, what you're basically saying is that um, there's a few places where that money could have ended up. It could have ended up to us in the form of loans, in the form of credit, perhaps increased productivity through regional bank lending, something like that. It could end up with the government, could end up with the central bank, but effectively it ended up just doing nothing. It's like latent credit. It's the table was set, but no one was showing up, that sort of thing. And ultimately, it's a psychological problem. And I've heard this before, that inflation is it's not just about money supply. That's just really just loading the weapon. It's about the psychology of shooting the weapon. And right now, and probably for a while now, the banks have been, it certainly feels like they've been tightening the screws in terms of their risk appetite. So I guess what you're saying so far makes a lot of sense, that there's very little incentive for the banks to extend credit. Is that right?
Yeah, yeah, no, indeed, that's what I'm saying. There was a metaphor I was using quite a while back, which was it's as though we're living in an igloo. Why an igloo? Because you know the banks have been conservative. It's been, if you will, they've been frigid, cold. They've not been partying, and the igloo is has been doused in paraffin,
Yeah.
and we're really, really damn cold.
Yeah.
But I keep, like you and I keep passing you the lighter. I'm like, you go, you're like, you go. Procrastination, procrastination. So
Yeah.
yeah, again, later and later perhaps, but I have a hypothesis that the country that started quantitative easing in 1990 or so, Japan, the country that's on the 27th iteration. I mean, there's a clue. Look, they've tried
Yeah.
it 27 times, it didn't work, and they keep changing it. Maybe it just doesn't work. What are the chances that the 28th time will work? But if you will, there's a lot of metaphorical gasoline swishing around the Japanese banking igloo. And what if the brothers just went, maybe that's what Dollar Yen's telling us, but.
Well, yeah. Do you want to unpack that a little bit more? So, effectively, what you're alluding to is that this isn't necessarily a phenomenon that starts and finishes, and the story's fully told in the U.S. This is more of a globalization piece going on. Is that right?
Well, for sure it is. Okay, so let's go global.
Yeah.
I want to kind of again. Uh, so there's a lot of attention given to the dollar reserve currency status.
Yeah.
Um, but there's never really been a reserve currency, like sterling, which would be the nearest comparable, the late 19th century. Um, it was its proximity, or it was the confidence that investors had that you could redeem it for commodities. So it was actually we were on a commodity collateral monetary creation system.
Yeah.
And I want to say that today we're not on a gold or silver collateral system, but I believe treasuries have are essentially the collateral,
Right.
and so this is going to allow us to take the leap away from sovereign dollar creation to offshore non-sovereign dollar creation.
Yeah.
And it is simply a fact that if you present a good collateral, what is deemed to be riskless collateral, namely US Treasury bills, and sometimes with a bit of longer tenor, that overseas banks will extend you credit and almost with no haircut. Um,
Right.
and that is money creation.
Outside of the U.S. system.
Yeah. And it goes unrecorded. I guess it gets recorded when when there's a transaction which has an impact on U.S. deposits.
Sure.
But I'd say it's largely unrecorded, and it's largely the factor which has imbued asset price inflation. I think there's, first of all, the euro-dollar system um, is dark and mysterious, and so it lends itself to bodacious presumptions on the macro world. But hey, why not? I did a great show, the Asset Capitalist show last week with Bob Elliott, who
Yeah.
was formerly one of Ray Dalio's kind of gurus, was kind of responsible for the FX bucket there in the all weather fund, and macro is all about um, an awareness, an understanding of previous macro cycles. It's not that many. There's really not that many. I mean,
Right.
if you had an AI model, you could really wrap it quite quickly.
Okay.
Uh,
Yeah.
and indeed, Charles Kinderberger, Manias, Panics, and Crisis, is like the Bible of that system.
Right. Okay.
But we were talking about, so we kind of know it. You go looking for trace elements in charts, long term charts, where there's been a disturbance to the price series, and then you kind of fantasize. I mean, I was looking at the British sterling, the cable rate versus the dollar today, and you look at that, and so from a chart perspective, it's just grotesquely bad. It has rallied from almost parity to 130, but there are very clear indications. I mean, FX is it's partly all about charts and trying to draw out the emotions and gut feelings of the traders.
Right.
Um, but there's a clear overhead resistance where it's trading. There's a clear downtrend on it. They're both coinciding, and
Right.
this chart screams at you, "We're going back to parity." Okay, and
Right.
that's just a damn chart interpretation. But then you look at the UK, and and all the Anglo-Saxon satellites orbiting the US have a radically different mortgage market. Pretty much everyone gets fixed on mortgages for 2 years,
Right.
um, and that's certainly the case in the UK. It's not
Right.
the case in America. I mean, we're
No.
having a remarkably complex period of Fed tightening because um, the private sector fixed everything at like 2% in
Yeah.
2022.
Yeah.
And
They're
they
immune.
for
Yeah.
30 years, not 2 years, 30 years. And the Fed's
Yeah.
like, is pressing the nuclear bomb, is like, boom, 5% interest rates.
It's not working. Yeah.
Nothing's happening. Like, go
Yeah.
again. Boom, 5.25. Nothing. I don't know. Boom, go again. 5.5. And we're getting to the point where we're like, because you'd expect someone to blow up, and the private sector's like, no problem here. But of course, with the Fitch downgrade, there's always a
Yeah.
problem. And the weird thing about the US cycle is the most exposed agent is the government. They
Yep.
they never they never fixed for 30 years. They were issuing the 2 year. And now I'm like, you mean we're paying 5%? You mean our interest payments to GDP? We're about to hit $1 trillion. We're 3% of GDP. I'm
Yeah.
like, mad. Like we might have to rein it in a bit. So anyway,
Yeah.
but in the UK, so there we are, and we're looking for. We saw a chart, very long term chart, a chart which just kind of it warns, it's foreboding of kind of not very good things, and then that this mortgage market, you Bank of England policy or Bank of Australia or over in New Zealand and in Canada, they've been pressing the button and nothing happens, but the 2 year reset means that Jesus, it all happens now.
Totally.
Like,
Yeah.
so you kind of go looking there.
Yeah.
Um, so Eurodollar is one of those places.
Right. So,
And you
but basically, what you're saying is there's this almost like an illegitimate child factory going on in Europe, where these little dollars are spawning themselves, and it's creating these distortions that move around largely unmonitored. And you feel that perhaps explains why we're getting asset price inflation and maybe even consumer inflation. Is that right?
not the consumer, but the asset price
The
inflation.
asset price. Okay.
We've been left with the worst combination of all worlds, which is asset price inflation and wage price disinflation. You see that it's ripping the political economy apart because the real folk, the gap between their income and the assets that they can acquire, like the franchise that they can live under, is getting pulled. It's like a rug being pulled from their feet, so that's not good. The Eurodollar system. I don't like thinking of it as illegitimate. I think it as very legitimate. It's a system without regulation, without
Right.
uh, bank regulator oversight. I think anything regulator oversight just seems to add complexity and doesn't really seem to solve anything. I'd remind everyone that Credit Suisse this year went essentially bankrupt. It was deemed to be one of those 50 or 60 systemically important banks. It was subject to far greater scrutiny by the regulator.
Sure.
It had more demanding regulatory ratios, if you will. It went bankrupt despite the fact that
Yeah.
it was deemed to be safe on those ratios. So
Yeah.
the Eurodollar system is a system that I like because it's regulated by the confidence of your peer group. That everyone talks. Everyone like
Sure. Right.
that guy I went lent to him.
So it's
Right?
like the free market is ruling in that space more so, and that's kind of what you're saying, right?
Yeah, and so we saw back in 2008, you had bank spreads begin to widen.
Yeah.
When now we've got this damn so far thing, to trade Eurodollars and short sterling. These were interest rate contracts, which it was the market's best guess of where rates would be 3 months forward, but it also embedded a credit risk for the counterparty.
Okay.
And and to the Fed's great horror, they cut rates to the floor, but these bank lending ratios were actually going higher, and it was the credit because the banks didn't want to face each other. That was the Eurodollar system. That was banks saying, "Geez, like get me out of here." Um, and it's not, despite its name, it's not Eurocentric in terms of location. Um, Arguably, I think the biggest dollar creating um, metropolitan in the world is Tokyo, the Tokyo
Right.
city center banks, and there is a presumption that I have a presumption rather that they finally went to the Eurodollar, the window, if you will, like the cashier. I mean, think of it as a pawn shop, and you go in, you're like, hey, hold on a second, and like you boom onto the counter. You're like, I got 100 trillion yen, risk free. I mean, negative yielding, Bank of Japan, crazy people, but rock solid, current account surplus. Well, how many dollars would you give me for 100, 100 trillion yen? And you're like, wow, well, we'll give you $1 trillion back. And why it typically goes into asset prices. It's not given to entrepreneurs. It's not influencing wages directly
Mm.
because it's a 24-hour lending cycle. You have to kind of go. They can call you every 24 hours and say, you know what, we're changing the terms. We want to change the collateral. We want whatever, and so it's not the kind of lending or borrowing that you would commit to a 20-year payback. Building a bridge, building another bridge in
Right.
China. That's not what
Yeah.
you're doing. Yeah, you are like speculating. You're putting it into stocks, or you're giving it to a hedge fund, etc. It's very liquid, very now. And I'm just curious that if you look at dollar yen, and you look at it on 30, 40-year price ranges, such has been the impulse of the weakness of the yen the last 2 years, that it's beginning to throw up the conjecture, the fantasy of the yen trading at 200, which would be 50% devaluation on where it was 18 months ago, or even 300. And so, my job is to kind of try and work back from these fantastically crazy and scary scenarios, and then kind of say, how could that be? What would the manifestation of that be? It might be that the large Chinese banks followed their customers into mainland China. Mainland China was so consensual with its economic growth for the last 15 years. So mainland China is always running is structurally short the dollar. You're an exporter, you receive dollars, you've
Yep.
got to hand those dollars back to the state, and you're sitting there with what I call red cabbage. But you want to sell goods overseas again. Maybe you need iron ore, you need oil, you need dollars.
Yeah.
And so there's a whole intricate web of banking offshore, which facilitates you getting those dollars and that commercial trade happening. That's a good thing. And I think the Chinese were aided and abetted by these large Japanese banks. They're sitting at home. No one loves them. No one wants to borrow from them. They're like, let's put it all on the house. And so when you do the conversion in the euro dollar system, you're shorting the dollar,
The US dollar. Yeah.
US dollar. And so on a kind of 24-hour rolling cycle, I kind of want to say that that short has been called somewhat, and that squeezes the yen, and it pushes up the value of the dollar versus others would argue, but others of a more saner, calmer disposition, those that don't wear acid capitalist hats, would tell you that really the kind of 40% devaluation in the yen is more a function of the profound carry. That if you're a domestic institution, you can borrow for minus 10 basis points,
Right.
and if you were willing to run an FX position, like you could buy US Treasuries today and get 4.05, so you'd be getting 4.15. If you were buying at the 2 year, you'd be getting 5% plus, 5.5%,
Right.
5.6%. They would say once eventually the Fed will narrow that, those rates will come down, there'll be a recession, and so the yen will appreciate once more versus the dollar, and we might find ourselves back at around 120, 125.
Okay.
That would be a more orthodox version of where we are, but the fun, the juice, the convexity's in the tail, and tails are more interesting.
Yes, indeed. Now, the rest of this episode I'm going to share with you next week, remember, but you're more than welcome to check out the YouTube version for the extended episode right away. Now, if you found this episode a little bit tricky just to keep up with, don't worry, you're in good company here. And I've listened to this 5 times, so it's starting to get a lot easier. It's starting to make a lot more sense. So have another crack at it yourself. Make sure that you tune in next week for the next part. Today was an alternative explanation, though, to what really moves asset prices. That includes the share market and the property market and even the crypto market. Next week, we're going to fold in interest rates as well. Jeff Schneider from the Eurodollar University, George Gammon, and Dr. Richard Werner. They all talk about this sort of topic around the Eurodollar system a lot. And if you're looking for more information around how that all works, it's highly probable that they will have the answers. And what I've been getting out of this is that those who can maintain ownership of assets in the next bull run, or when things kind of quote unquote get back to normal, will probably benefit a lot from how this murky part of the financial system actually works. It's not doing much for the everyday person, though. And I've often been critical of central banks for assisting in widening the gap between the haves and the have-nots. But now I'm wondering if it's more of a structural issue, more systemic than that. Why is that relevant? Well, while we're all looking for where central banks are setting interest rates, there's likely far bigger forces at work that most of us don't understand yet. So that's why I'm having this chat with Hugh Hendry. And again, anyway, thanks again for listening in, and I hope you have a fantastic week, everyone. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And UGRO & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.